Jimmy, this is always the moment where the we can we make a joke about saying things, but we never really say anything that's too interesting.
Where are you on location this week, Rob? Let's start there. And very snowy and
Well, as I understand, we were just talking to Amy. It was like 70 degrees yesterday and 30 degrees in Ohio today.
Mhm.
The temperature has plummeted apparently.
It has, yeah. It's been a crazy winter weather-wise here on the North Coast. So a lot up and down.
Yeah, that whole climate thing, you know.
Right.
What's that?
It's hard to figure out. Yeah, it's weather patterns seem to be inconsistent. But what do I know?
Yeah, I people talk about every time I mention climate change in my commentary, I have to be very careful because it's a sensitive topic,
Mhm.
unfortunately, so I just kind of say, whether you believe it or not, whether you believe in it or not, if the insurance companies believe in it and the companies buying servicing believe in it and investors believe in it, then you know that's the deal.
That's right.
Um, I happen to be. I'll give you a hint where I am. Okay.
Okay.
And Jimmy, don't worry, we'll get to you in a minute. All right. So where I am is was in some Johnny Cash lyrics. Okay.
I know Ring
I
of Fire.
shot.
I know Ring of Fire after that. Bad, yeah.
Your Johnny Cash lyric knowledge falls off dramatically after that.
Just the chorus of Ring of Fire. That's all I got.
Jeez. So I shot a man in
Omaha. Twinsburg.
Folsom City Blues, Rich. I
Folsom
shot a
City.
man in Reno just to watch him
Reno.
die.
Oh man. All right. Yeah.
So yeah, Johnny Cash made that, sang those lyrics. And so when I tell people, yeah, I'm in Northern California living in Reno, they say, oh, Reno. Yeah. Have you shot a man yet just to watch him die? And I usually say no, which is the truth. But yeah, you talk about climate. We're getting a fair amount of snow, as you can see, which is unusual. But anyway.
That house in the background, it's very picturesque. Is that yours? That's like Swiss Family Robinson. That's
my manservant's quarters.
That's the servant home. Is that your
speaking of which, and Jimmy will get to here right now. So the first time, you got to tell this little story about the first time I saw Jimmy was at a conference, and there was a group of people. You know how, like, if somebody's breakdancing, there's a circle of people around the person breakdancing, and they're all like oohing and eyeing and watching. So I walked into the opening reception or something, and there was Jimmy surrounded by a group of people, and they were all looking at his fancy shoes. Okay, because Jimmy is renowned for having really, really nice shoes. And there were a group of people standing around, and I asked the person next to me, I said, who is that over there? And he said, oh, that's Jimmy McGurk with National MI. And they're all looking at his shoes. So is that true, Jimmy, that you that you like to sport a nice collection of footwear?
I don't know how true that is, Rob, but I like to look nice, especially around people like yourself. So, yeah.
Oh, that's a mistake. That's a mistake. Actually, Rich, we were talking before you came on, and when National MI was just getting started, Pete, I think, asked me to come over and speak to the group, and it was, folding chairs and folding tables in the National MI lunchroom. That's how small the company was back then. And I think, I talked about what the industry was doing and how important it was to have another MI company out there and so on. So that's been, when did National MI, what year was that, Jimmy, that National MI started?
2012.
Yeah. 2012. So it's
10-year
been 13
anniversary.
years.
10-year anniversary. Yeah, just recently. So,
wow.
Which is awesome, because I've made this claim before. I may have been the first National MI lender application ever. My good friend Sue Schaefer took a new job, and now here we are 10 years later. And you guys have done a lot of great things for the industry. This is, by the way, this is Jimmy McGurk, the VP National Accounts for National MI, who we are lucky to have on the show this week. And Jimmy, before I get into the NMI stuff, I in the show promo run up, I got at least 3 or 4 notes from people asking how you're not on my top 25 best names in the mortgage industry list. I gotta have my people look into that.
Should I start lobbying for that?
There are people that
Make
lobby
that list.
Yeah. Bobby Nagme, he's all over me because he went down from like 16 to 18, and he just doesn't, he doesn't understand it. He feels like his name has gotten more viable. So it's become quite competitive.
It's tough to get on that list, Rich. I think some people pay to be on that list. Is that true?
It's not like the hey, if you want to be like the industry pioneer, for 2023, just pay your $30,000 app fee and you're going to get awarded.
Right.
So,
Yeah. Support TMC. I'll tell you, Jimmy, I'm on their expense account. You can see the kind of meals that I can, the McDonald's Happy Meal I went with today. That's the level we're at here. So do what you can to support TMC.
Love it. Let's go ahead and get into it. And this is the rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative. As always, join my esteemed colleague and co-host this week in a picturesque snowy setting, Rob Chrisman. Rob, great to see you.
Good to see you too. I see that you use the saffron infused conditioner today, Rich, in the shower. It's looking good.
Thank you. I worked on it for several hours before the show. So
yeah.
And this week, very pleased to have a special co-host, the VP National Accounts for National MI, Jimmy McGurk. Jimmy, good to see you. Looking forward to the conversation today.
Thanks for having me, guys. Appreciate it.
And as noted, NMI recently 10-year anniversary, long-term partnership with TMC, one of the companies that does a lot of great philanthropic things in the industry, is doing a lot of cool, new, innovative stuff, and a great partner. And really excited to get your spin on the industry and all the really relevant news stories we're about to go through this week. So, but thank you, Jimmy, for your partnership and for joining us this week. Rob, your hands up.
Did you say philosophic or
philanthropic?
Philanthropic. Okay, I didn't know if they were going down, Plato or Homer or philosophical. And one other question, Jimmy, do you call yourselves, like when you're talking to one another, coworkers, NMI or National MI?
I'd say it goes both ways, but typically NMI.
NMI. Okay,
Yeah.
Good to know.
Love it.
Thank you.
So Jimmy, looking forward to getting into the conversation. It's funny, we have you on the show this week. It's been planned for a while, and we get the FHA insurance, not maybe a friend of the MI companies, but I don't know. I got to mention it because it's huge news, but I figured I'd just lead with it and laugh about it and see if you have any thoughts on it. So
yeah, I know it's funny. Actually give Rob a plug. He had it in his write-up the other day, but our trade group, USMI spokesperson, came out and made some comments about the new rates and stuff. And it's funny because he didn't really say anything negative about lowering the rates, other than, as an advocate for our industry, we're putting private capital over taxpayer dollars. So, when we look at it, it's a good thing for the industry. Hopefully more borrowers can afford homes, put borrowers in that position to buy a home. But I don't really see it taking from the PMI space necessarily. They kind of play in a different credit box than we do. I mean, I'm sure there's some overlap. But again, our industry is always promoting the private capital angle versus the taxpayer dollar stuff. So it'd be interesting to see where it goes. I haven't gotten any projections from our numbers people as to, where they think it'll affect us. NMI, our probably experience the last couple of years, is we've kind of played in the higher quality borrower space, focused on the higher FICO scores, not lower LTVs, but 85 to 95 LTVs. So it'll be interesting to see with these reduction rates where that business grows for FHA. So.
Awesome.
I think Rich, to echo Jimmy's point, it once again shows us the ripple effect of a change that one group makes and how it may impact other companies or other segments of the industry. Somebody makes, Fannie Mae or Freddie Mac, they adjust their pricing. And so the non-QM industry, for example, takes notice, or the loan limits go up. And so the jumbo investors take notice, and it's all, representative of this ecosystem that it's important. And I don't know, I'm not privy to how much, HUD might talk to FHFA, might talk to jumbo investors about changes that are being made. But yeah, I mean, different companies and different segments play in different spaces, as Jimmy points out. And I think it's important for people on the call to take note of that.
Very well said. And we've been hearing anecdotally, just because of some of the lower MI premiums that we're seeing right now, that, the side by sides, the comparisons of 5% down deals, MIs winning a lot, if not most, if not many, especially on the higher credit end right now. Not surprisingly, with premiums lower. So we'll see how that all plays out this year as we get into it. So, Rob, a lot of stuff in the news this week. The aforementioned FHA MIP reduction. We got a pretty toasty inflation number this morning. The PCE index, the Fed's preferred gauge of inflation, that came out up 0.6% month over month, was definitely hotter than people were expecting. Also got a really smoking hot new home sales number for January. This is really building on what we've been talking about and seeing with the builder community these last few months, some of the builder confidence indices, builder stock prices. And now we're seeing in January, new home sales were up 7.4% amidst expectations for basically flat. So it's a big miss to the upside. So I throw all that at you, as I always do, to get your reaction.
Yeah, Jimmy, Rich is good at asking 10 questions in one paragraph, but I always, putting on my secondary market hat here a little bit, I always hearken back to when something misses expectations, either to the upside or the downside. I always wondered, okay, is that indicative of the number or indicative of the people setting the expectations and making the forecasts, and they were the ones who screwed up? Anyway, that aside, yeah, the U.S. economy continues to chug along. The inflation numbers, despite the Fed, the Fed's moves in the last several months, continue to be, it's solid. And I mentioned it this morning in this morning's commentary, today's commentary. Economists have talked about a soft landing or a hard landing as we come out of this, and now this talk of no landing comes out of it. Is the U.S. economy potentially just going to cruise along at inflation of 5 or 6 or 7%, almost regardless of what the Fed does? In which case, is there a kind of a new way to think about things? But the fact is, the U.S. economy is doing okay. Anybody hoping for 3% 30-year fixed rate mortgages continues to be sadly disappointed. And we could chop around at these levels for quite some time. So, it's an interesting thing. From the beginning, everybody knows the U.S. economy. The analogy that we've used, Jimmy, is it's like an aircraft carrier trying to turn an aircraft carrier. It's not a PT boat. And so the actions that the Federal Reserve makes through the Federal Open Market Committee take months and months to really get infused into the economy. And we're seeing that now. We've been raising rates, and overnight Fed funds or whatever, I don't know, 4%, 5%, wherever they are now. But it's an interesting situation where the U.S. economy continues to be strong. And on top of the numbers this morning, Rich, when you look at the savings rate actually picked up. And the underwriters that I've spoken to in recent months talk about the increase in credit card debt that they're seeing with borrowers out there. It looks like credit card debt is going up, but here we saw the savings rate pick up a little bit. So maybe the U.S. consumer is not eating into their savings as much as one might think, or using credit cards as much as one might think. But we continue to chug along, and so rates are where they are, and don't appear to be coming down anytime in the near future. but I think over time they'll probably drop somewhat. I wanted to ask Jimmy though, Jimmy, I mean, you have clients all over, I guess, the central part of the United States, correct? What area do you actually cover?
Yeah, so I work for our national accounts group, and we have accounts all over the country. So probably most of the accounts within the top 150 fall
Okay.
to our team. So it's not really geographic; it's by relationship. Some of it's geographic, but by relationship. But yeah, so all the top accounts, Wells, Chase, Fairway, all of those.
Right. So are you seeing among your clients then any kind of general trends in terms of the quality of loans or the amount of debt that the borrowers are seeing? Or, I mean, if somebody asked you for a one paragraph description of what the typical borrower is like now, say versus a year ago or 2 years ago, what would you tell them?
Yeah, so at least from our conversations with our operations team, going about from the loans that we actually look at, the quality still seems to be high. Like, we're not seeing the credit box being pushed yet. So the quality is still good. Like I said, we have a mix of customers that send their stuff delegated, which means we give them the authority to approve the mortgage insurance on our behalf. And then we have probably half that send loans either through contract underwriting or through what we call non-delegated. But we're not seeing any decrease in the quality so far. So
CoreLogic puts out this week, only 3% of all mortgages in the US, more than 30 days delinquent. It's down 0.5% from a year ago. It's amongst the lowest levels in history. So Jimmy, that seems to match up with what you're seeing from your clients, which are a lot of big mortgage lenders across America. Mm-hmm.
Yeah, it's funny, Rich. I mean, I love to make fun of statistics. And so if we went, say, from 3% up to 3.3%, because here we are at historic lows.
30 years, right?
Right. It's like, oh, delinquencies shoot up 10%, skyrocket up 10%. And they move from an all-time low to just a little above an all-time low. Yeah, that's what I'm hearing. All the trillions of dollars of mortgage debt that's out there is very, very low delinquencies, foreclosures. I think forbearance continues to remember forbearance when all we were talking about a couple of years ago was forbearance. Now it's like, less than 1%. I mean, it's minuscule. And the credit quality of the borrowers that are out there that have loans and the loan to values with the increase in property values. I mean, we're in very good shape. It's hard to really find fault with what's going on now in terms of lending and the trillions of dollars of outstanding mortgages that are out there.
Very healthy.
That said, I need to ask Jimmy something without mentioning names, Jimmy. So every once in a while, I will see a headline that Fannie Mae and Freddie Mac have increased their buybacks. They're going back to lenders and saying, buy back this, buy back that. Is that something that you get involved in as a NMI, see much of, or are you aware of what's going on with Fannie Mae and Freddie Mac in that area?
Yeah, we do, because typically if there's a buyback and has mortgage insurance, the lender will notify us that if it's something that's going to affect the insurance, or if we were involved in the loan through contract underwriting. So, again, it's only limited to loans with mortgage insurance, but we do get notified when that's going on.
Have you seen an increase?
Again, I'm not aware of anything significant. But and this is anecdotal because I don't deal with that on a day-to-day basis. It seems to come in waves. Like it'll be quiet for a while, and then it's almost as if the GSEs got everything together and then pushed it back at the same time. But I haven't noticed. I'm not aware of a significant increase in buybacks. But we have gone through periods where a group of them seem to come in at once. So it seems like the lenders were notified all at the same time that, hey, we finished our audits and here's what we found, and then they communicate down to us.
Yeah. Have you seen, kind of related to that, have you seen an increase in, or are you more worried about your typical, worried is I don't know where I'm going with this. I know where I want to end up, but I don't know how to get there. So counterparty risk is a big issue right now. Companies had spectacular 2020s, 2021s. Everyone got used to the margins and the volumes and everything, and they knew it was going to end, but they didn't know how fast it was going to end and so forth. And so a lot of companies in 2022 really, for lack of a better term, took it on the chin in terms of profits. A lot of companies went out of business. They're continuing to consolidate. They're continuing to wonder if they want to be lenders, and mergers and acquisitions continue on. The latest example being Mutual of Omaha buying Keller Williams Mortgage. So my question to you is, with counterparty risk and looking at the lenders that you are dealing with, obviously national accounts, you're dealing with very strong counterparties, but NMI's lower tier of lenders that you're working with, are you seeing the financial strains continue, or do you think things are under control now?
No, I mean, so for us, I would say is under control for now. Even the smaller lenders the ones that we're working with still seem to be financially viable. We haven't had any worries as far as companies going out of business. What I think is going to be interesting over this next year is just the acquisitions and mergers, like you mentioned, the Mutual of Omaha thing, and to see where that goes. You hope, or it should be, that the stronger financial companies are acquiring the weaker ones, so that bodes well for all of us in the industry. But we haven't seen any degradation in the customers that we're currently dealing with, even at the smaller level.
Yeah, you don't want the analogy that I use is two drunks leaning against one another in an alley. You don't want some kind of merger where the two drunks leaning against one another scenario. You want a strong counterparty, and you want obviously the efficiencies to increase, and we don't need two capital markets departments, and we don't need two sets of underwriters, and we don't need two sets of doctors and funders, and we can be a healthier organization when we merge. Does NMI get involved in mergers? For example, do parties contact you and say, hey, we're thinking about this confidentially, or do we have your blessing? Are you involved at all in the decision making that goes on?
Not until it becomes public. We're typically not brought in prior to anything that's doesn't come out in any of the publications that we all read. So for instance, like one of the accounts we're working with now is TD Bank and First Horizon. So like when that was going on, we weren't notified until it became public, and they let us know, hey, here's where we are in the process. Typically what they'll do, if it becomes a new entity, they'll get a new master policy under that entity, or it'll move under to the acquiring entity is.
So when you are in, go ahead.
Go ahead, Rep. No.
I was going to ask Jimmy. So when you are dealing with a lot, Wells, a City, a Chase, a Fairway, a Guild, United Wholesale or whatever. I don't know if you guys are seeing the snow. What the typical conversation that you might have with them as the NMI rep for national accounts? What are the current topics that are being discussed at that level?
Oh, well, you can imagine most of them are looking at, cost reduction just with the drop in volume. You saw the Wells announcement, their strategy shift from, what they were a couple of years ago to, focusing on the bank footprint. And then I guess they're going to correspondence going away and servicing. So this year more than ever, it's a conversation about what their strategy is to stay lean and have the appropriate expenses tied to the volume that they're currently producing. So that's a big topic.
Yeah. Good. I'm sorry, Rich, what were you going to ask?
No, I was just going to say the Keller mortgage getting acquired this week was interesting to me, because I think it officially represents the end of like the real estate owned mortgage company. I mean, you think about it. It's on some level, it seems crazy that these realtors can't have effective in-house mortgage companies. They all tried to do it like 6 or 7 years ago. Keller started their in-house Keller. Remax decided to do like the Motto mortgage. Everybody's going to be an individual broker thing. Berkshire Hathaway, I think, had 3 mortgage companies that kind of fed into the parent company that now is down to 1. So I thought that was interesting. Redfin, I see in the chat, Redfin.
Bay Equity.
Bay Equity, that is an acquisition that happened about a year ago that, I know is coming together. So, but it's interesting to me. And I think, just having presided over a lot of marketing services agreements with realtors, like realtor broker owners don't make as much money as you think they do, and they need that mortgage referral income, and I think it just inherently, it makes it tough to have your own mortgage company. Jimmy, Rob, any thoughts on that?
Yeah, I'll chime in. Then Jimmy, you can join in. So I'm pretty close to the guys at Bay Equity and Redfin, and they just came out with their announcement. I remember when Redfin bought Bay Equity, and the guys at Bay Equity are like, Yahoo! They were screaming and yelling and shouting from the rooftop, and I'm thinking, you lucky sons of guns, out there, shouting from the rooftops about this deal. And Redfin just posted their earnings, I don't know, within the last week or so, and they lost a lot of money, and Bay Equity lost a lot of money. So Bay Equity was not immune to the downturn in the industry. And
one of the
you
most
can
well-timed sales ever.
Oh, yes. The boys at Bay Equity are probably watching this show from a boat anchored in the San Francisco
Hosting,
Bay right
champagne, right?
now. Right, caviar dreams. So it's an interesting, the whole M&A thing, and I talk about it actually in tomorrow's commentary, with the whole mergers and acquisitions. There's a knack to it, and I know that Guild, I'll just throw their name out there. Guild is acquiring companies. American Pacific is acquiring companies, and there are different ways to go about it. You can actually acquire the company, or you can subtly just hire all their producers, and then you're not assuming the op staff or the liabilities of the company, and that's one way to go about it. And there's a lot going on that doesn't get in the headlines, in terms of mergers and acquisitions and little companies that are, transitioning producers to other companies and so forth and so on. But I would think, I'm going to flip this over to you, Jimmy, in terms of the M&A environment. And, obviously the number of companies the number of lenders are going down. Certainly the number of originators are going down. I've heard some horrific originator statistics, like only 50% of NMLS licenses are being renewed. Are you seeing anything that's not public? I shouldn't say not public, but in your opinion, do you think M&A, for example, will continue in 2023 or you see it petering out here a little bit?
Yeah, that's a good question. I would think it would continue. This is just my opinion. I think it would continue through where companies can be opportunistic. I think they will. Like I said, a lot of the conversations that we have with our lenders right now, or what lenders share with us, is just their concern over their overhead. And you staff up for the last couple of years when volume was a lot more than it is today, and now you're trying to figure out, well, do I reduce down to what the volume is, or do I go down to a capacity that meets what I think it's going to be? So, the way our industry is historically, it's like everybody cuts, and then next thing you know, rates drop and production kicks up, and they're running around scrambling, trying to hire people again. So a lot of them, I think, now are looking for technology. Like, how do I find technology to replace what used to be a manual process? What's out there, what platforms. So I think that's a big opportunity, or a big focus for our customers in 2023 is, are there opportunities out there to acquire where it makes sense? Like you mentioned Guild's a customer of ours. And then how do I replace things that used to be done in a manual process with technology to replace that?
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Chrisman, and this week, National MI's Vice President of National Accounts, Jimmy McGurk. Jimmy, great analysis there. And, I think I remember the 17-18 winter was brutal. And,
17-18, you mean like between 17-17 and 17-19?
2017, yeah, 2017.
27. All right.
It's not 19, 17, 18, Rob. I know that we're big in that era, but we're talking about 2017. And I just remember like it was brutal. And I remember that, a lot of lenders just confidentially to me were like, had like the towel in the corner, like ready to, and then we got a great lift in the spring of 18. And, like this year, just talking to lenders every day, it was like we had this optimistic start to the year. Rates fell in January. We got that combination of like positive inflation data, yet still positive labor and spending data. And then we've kind of had a little reversal in February, most notably on the inflationary side. And it's kind of reversed things. And, I just know for a lot of lenders that were, optimistic a month ago, it's now it's a little bit tougher of a situation that could potentially inspire, more activity. So
I'm going to ask, sorry, Rich, was that a question or a statement?
no, just,
No,
yeah.
just rambling on. So Jimmy, NMI, is there anything new under the sun when you're talking to the national accounts or even the smaller accounts? Going back to what I asked you earlier about what is the conversation that you're dealing with, and you talked about how they're saving money and how they have a plan to go forward. From a mortgage insurance perspective, I've heard, I've heard that there are other mortgage insurance companies out there, but what do I know? NMI, what do you guys have new? What anything you can share with the audience?
Yeah, well, a program that's it's what's old is new again is temporary buy downs are becoming popular. I had a conversation with a lender the other day that's doing a significant amount of those just to help get loans in the door. With risk-based pricing, I don't know how aware you are of the evolution of the mortgage insurance industry with risk-based pricing, but I was talking to our numbers guy the other day, and 84% of our business now comes in through risk-based pricing versus rate cards. So we still have some lenders out there that prefer the rate card, whether it's a technology limitation or a compliance concern. But so really what you're seeing is like I said, with technology, these platforms are becoming very efficient at best Xing the MI space. And so what we're seeing is the evolution, and a lot of this was accelerated through COVID, that lenders with, Empower or Encompass platforms, they're able to best X their MI and get the best possible rate for their borrower. So, there's still the traditional, we're seeing right now too, a big move to with production down is people are retooling themselves and using our our training options. A lot of that's online now. So you go online, you can take these different classes, whether it's sales skills or traditional underwriting, self-employed borrower type thing. So we're seeing a lot of that. But yeah, definitely, the movement towards risk-based pricing and best execution is huge in our industry right now.
It's interesting you mentioned companies retooling or the industry retooling. Yeah, I see a fair amount of that. People recommend that I do that. I don't know how I would, but anyway, sorry.
Are there still physical? I remember the actual rate cards, Jimmy, back from my earlier days. Do those still exist? Can you get a physical?
No, and every now and then you walk into an office and you see it on a loan officer's bulletin board or something like. I don't know where they get much, like a collector's item or something. It's like collecting baseball cards.
Right, like my new Barry Bonds Gem Mint atomic refractor. But I was thinking maybe like a Jimmy McGurk signed rate card.
Oh yeah, that gets you absolutely nothing.
98, if in good condition, could be worth something on the secondary market. No.
Oh my gosh. Oh my gosh.
Oh, we divert as usual, but
Digress. Not
digress.
only divert, but digress. Yeah, Jimmy, I don't know how, I'm sure you watch the show every week. Yeah, Rich has cards in front of his laptop there that he pulls up periodically to
very good for
the
my
flash.
Yeah, very good for my mental health. The men on cardboard that I collect. Yes. So what I wanted to get into, though, with the last portion of this show is just what I've been hearing from mortgage lenders, across America. And it's like they're trying to make sense of what this year is going to be. And it's the hotter than expected. The hot inflation numbers are kind of suppressing the mortgage industry right now. Wanted to, because I think this is what's on the mind of like Joe, loan originator in this type of climate with these types of rates. It's very difficult, even for the best. A slightly healthier climate combined with some of the positive things in the undertone could really kind of take off, but it just feels like we're going to need a little help interest rate or wise this year for the year to be what most expect it would be. So I bring this all full circle. This morning we get a little hotter than expected inflation number. And is it, I know we've talked about this before, Rob, and would welcome Jimmy's thoughts on this too. Is it, I think the way the Fed is calculating employment just based on all the different ways to make money now in America, I just think it's off. Most of these job indices focus on full-time work or employers that formally report employment. My sense is that there's more of the other going on right now, and that labor, even in its very healthy state with very low unemployment, is actually unreported. And the labor situation and earnings that people actually earn is more robust than what the Fed thinks. And that is why spending keeps elevating and not abating. Is Rob any? I know I keep going on this, and
I want to get here Jimmy's input.
Jimmy, your thoughts on this?
Well, I definitely think the industry is waiting for some kind of push. Like, I don't know enough about the basics of the numbers to say, yes, that's actually better than it is or whatever, but it feels like no one wants to originate, or even the borrower, the consumer doesn't want to go in and get a mortgage at these rates when they feel like, oh, in 3 months or 6 months, it's going to drop back down again. So it feels like we're in a holding pattern waiting for something, whether it's a report or some kind of news that comes out that allows the rates to drop down. Because it just feels like for the last several months and in the first quarter of this year so far, everybody's waiting for some news to hit. And so we're kind of like in this holding pattern.
Is it all inflation news, Rob? If you're Joe mortgage originator out there, and you are very interested in the future direction of interest rates, is it as simple as just tracking inflation because of its importance right now and everything going on?
No. So you're gonna fire me up here, Rich. So, by the way, I need to interject. You didn't ask about the coat.
I do like your coat. Yeah.
Before we start losing, viewers, this coat is from when men were men. This was my dad's coat, and he used to, when he was in the Navy, one of his duties was running a fleet tug from Honolulu, Pearl Harbor, up to the Aleutians and back, doing that route. And this was his coat in the 1950s that he would wear, like I say, when men were men. And so he was out there. You mentioned rate cards hearkening back to a previous era. And up in my mind, I thought, well, here's a previous era. Also, every once in a while, I will see somebody with a gold book, a Fannie Mae gold book. Remember those? When you look at what originators, when I talk to originators, talk about hearkening back to another era, they aren't so concerned about rates. They are, and this is something I tell audiences, they are not being paid by borrowers to predict interest rates. I have never once talked to a loan officer or a broker who, when a potential borrower comes through the door, says, you know what, Rich, I think rates are going to go down in 4 months. So why don't you come back in 4 months and then I'll help you then. They are there to take advantage of the environment, but also take advantage of the opportunities in terms of the programs and the products, and the NMI, the mortgage insurance possibilities and so forth. They are there to structure deals for borrowers regardless of interest rates. So I think it's important for originators to know why rates are doing what they're doing. But then they quickly go back to trying to help borrowers and figure out the programs and down payment assistance programs and so forth, and mortgage insurance options that they can give these borrowers, like I said, regardless of interest rates.
Jimmy, you mentioned buy downs earlier. One of the other news stories, it wasn't in our show notes because it just came out today, but it was the John Burns Real Estate Consulting Group that does a big survey of builders annually. And 75% of builders offering buy down programs that, are non-traditional. I thought that was interesting, so I think it seems like it's setting up for, given the land, labor, lumber still headwinds that exist, some pretty robust new construction activity, especially as compared to recently these next several months. So is that anything you're hearing and seeing? You have any of the builder owned as clients of yours?
Yeah, we do deal with several of the builder-owned mortgage companies out there. They obviously are in a little different spot than the traditional mortgage company. You know, very optimistic about their opportunities for this year. Production will not drop as much as the traditional mortgage company. There's obviously still a lot of demand out there and little supply. So they're trying, like you said, with different supply issues, things like that, trying to overcome those to provide homes, but they're in a little different spot than the traditional mortgage company.
And we'll once again have Jerry Howard, the president of the National Association of Home Builders, at our conference, which is amazingly just a little over a week away. So always eager to hear Jerry's thoughts on what's going on. He doesn't hold anything back and gives you his unfiltered opinion. So that is always entertaining. Rob, a lot of Top Gun comments in the chat and the Q&A about your coat.
So let's getting back to the interest rate environment, Rich, briefly. You're dealing with the members of TMC. Are they waiting for lower rates, or are they just forging ahead with things?
It depends on the company. I've said it before. Everything is in who owns the company right now. If you're an IMB, and how much cash do they have? That is huge right now, but I can tell you there's a lot of, in my view, excellent companies that have been excellent for a long time that are, really starting to feel the strain. This Feb has been really tough. Not that the last 6 months of last year wasn't, but you get a little dose of optimism in January. If you're the owner of a company or an underwriter, and then you kind of have the fall off in Feb. It was just, I felt it's unfortunate that the year started out this way. I would rather have had January not be kind of rosy, but
yeah, there's a lot of
just because in the way that it affects their outlook and decision making and things like that. So
yeah, I would say that there's a lot of companies out there waiting for the purchase market to, the proverbial spring buying season to pick up or kick in, and it's not, certainly not happening here right now. But hope springs eternal, and it's important for lenders to have programs and vendors who help those lenders to have programs to assist in the purchase market. So when things pick up, assuming they do, that they can help borrowers that come through the door.
This is the Rundown with Rob and Rich. We've got a few minutes left with Rob and I, and this week's co-host, the Vice President National Accounts for National MI, Jimmy McGurk. We talked about CoreLogic a little bit earlier. They also made some other news this week, acquiring Roostify, one of the bigger point of sale providers. It caused some into industry to speculate what could be next. There, is a large loan origination system that's kind of publicly out there. So, Jimmy.
So you should, to interrupt briefly, not to toot my own horn here a little bit. You need to read tomorrow's commentary, Rich. I've got a great letter from a TMC member about that CoreLogic Roostify deal.
Excellent. I'll look forward to reading it. Jimmy, any inside info on that noise?
No, I just saw the announcement earlier today on LinkedIn, but I haven't looked into it. It is very interesting. It'd be interesting that they take the angle of looking at an available LOS after that. So that'd be interesting to watch.
Winds of change blowing for sure. And again, I think this little February kind of reversal maybe is accelerating some of that. Hopefully it reverses the other way, and we got mortgage lenders in 40 days that are like, oh man, it's it's starting to pick up. It's starting to come around because that would be great for our industry and for housing and our economy. So Jimmy, any final thoughts on NMI? Anything you guys have in the hopper for our audience before we take this thing to the weekend?
No, like I said, we'll be represented at your conference coming up in San Diego in a couple of weeks. We appreciate the partnership and look forward to doing great things. And Rob, always appreciate your insight. I got to think almost everybody in our industry reads your newsletter, and it's extremely valuable.
Well, I find out when I make a grammatical mistake or have a misspelling. Then I
yeah, when
find
someone
out.
gets something wrong, that's when you find out who read it.
Right. Or yeah, pretty much.
Rob, you're going to be test driving fighter jets this weekend, driving up and down the California coast with your sleeves rolled up and
on my putting on my Top Gun aviator sunglasses. Well, along those lines, Rich, I gotta say that Sunday I head down to Las Vegas, and I do get to, I guess, drive a fancy car on Monday ahead of the Ice Encompass event.
You got to roll in there in that coat with the aviators on, whatever hotel that conference is at. Just pull right up to the front door, just leave the car there, and just walk right in.
Drop the mic. Right.
And to our attendees, cannot thank you enough for wrapping the week up with us. We're here every Friday, 3 p.m. Eastern with the Rundown. The goal is to take you into the weekend with something informative yet light and hopefully somewhat amusing to help catch you up on what the hell has been going on in our industry outside your little silo during the week. So really appreciate your attendance. You can find this show on YouTube shortly after it concludes. And where the majority of you consume it on podcast, search TMC Connect, wherever you get your podcast. So until next week, have a great weekend, everyone. Rob, Jimmy, good seeing you guys. Jimmy, appreciate the partnership with National MI and appreciate having you on this week.
Thanks for having
me. Very
us.
much.
Take care, everyone. Have a great weekend. Take care.